Okay. So, so good evening, everyone. On behalf of JMFOA, welcome you all to today's session. So I'm Sivamohan Dharmalingam, a GP, going to moderate this. Some housekeeping tips. So please keep yourself mute, and we have a Q&A session at the end, so you can start writing your questions on the chat area. So this webinar marks the milestone in our journey. Began 5 years ago. Yes, we are completing our 5th year today. So the next webinar we have next month is the start of the 6th year. GMFOA thanking everyone who worked very hard on the screen and behind the screen to achieve these 5 years, especially Dr. Nishandan and Dr. Yoganayagam. Over the last 5 years, many of you, you have not only mastered the medicine through our webinars, but also you are making serious bucks. So now you are thinking, what next? Can I go to my accountant, or can I go to a financial advisor? For you medics to understand, your accountant is like your radiologist. So he scans your financial x-rays and tell you what is already happened. But your financial advisor is your cardiologist. So they are looking ahead. So they are monitoring your financial heartbeat and prevent the financial heart attacks. So today we are proudly present a seasoned and extremely experienced specialist financial advisor, Balvinder Thandi, for you. Bal is with Wesleyan Financial Advisory Service for the last 10 years. She has more than 30 years of experience in this field. Today, Bal is with her colleague, Holly. So they are both going to present this webinar for you. So I welcome Bal and Holly to share the expertise here. Thank you very much.
Perfect. Thank you very much. So hi everyone, just a quick introduction to myself. I'll just be in the background managing the slides for Bal, so I can't actually see anyone, but so today we're talking about general financial well-being, but most importantly understanding the NHS pensions and your options towards retirement. Really, we understand that there's many complexities of the schemes, and what that number could look like, the magic number we call it. When do you want to go? What are you going to get at retirement? Do you know when you can, what you're going to get at retirement, and beyond, really? So we work with medics all over the UK, in certain key segments that Bal will cover in a moment, but you're not the only ones. If you sat there and you don't have a clue about the pensions, amazing if you do know little bits or all of it, really. But we're really here just to provide you that guidance, and just allow you to open up to us about how you personally feel about your own financial plans in general, or your own pensions. Like it was said, pop all your questions in the chat box, but obviously you will get a chance to book an appointment, one-to-one with Bal at the end, where we can set you up for an initial discussion to talk about, anything more personal that we can take, off camera, on a one-to-one basis over Microsoft Teams. I will pass over to Bal to introduce a bit more about Wesleyan.
Yeah, well, good evening, everyone, and thank you so much for taking the time out to listen to myself, Holly, and your medical team. So, but yeah, I'm Bal. I've been around for a while now, and basically my role is to make sure that I can look to see how we can look to meet your financial objectives, not just now, but also in the future. So in the next 40 minutes or so, it's really trying to look at the areas that when I sit down with my medic clients, how I might be able to help them, and yourselves, obviously, and then, give you a bit of an insight of what we do, because we are specialists. My training and my knowledge is based around your profession. We've got eminent members of an advisory board that is made up of GPs, hospital doctors, dentists, and they bring us information as to what they are, the eyes and ears of your profession. They tell us what you need in order for us to give you the best advice as we can. So Holly's, are you all right moving with the slides for me at all? Or? It's okay. So it's really, if you've got any burning questions, just to put them in the chat. But also we will be answering them at the end of the actual webinar, so that we've got them all collated together. But in the meantime, what I'll do is, if I can just go through what we do and how we might be able to benefit you, if not now, then perhaps in the future. Okay, so we have been around for over 180 years. Sometimes I feel like that I've been around that long. But I don't know if the slides are working. It's just,
oh, sorry, let me try.
That's all right. There we go.
It's an issue.
It's working now. It's working now. Sorry. So so we've been around for over 180 years. So we stem from when the Industrial Revolution came about. Basically, a bunch of doctors came together. They started putting some of their salary into a pot. So if any of their colleagues went off sick, they were able to help them and their family. So this is where we've mushroomed from. And whenever you mention Wesleyan, the first thing members think about is income protection. But that's the reason that's where we grew from. But as I will explain as we go along, we're a lot more than that now. I think one of the biggest things I'm really proud of is that we're a mutual society. So we don't have to worry about shareholders, dividends, anything like that. As soon as you are a client with Wesleyan, you are a member of our mutual society. So any profit that we make goes back into the business, and it is shared amongst our investors, but also to improve our products and services. We've got an award-winning investment team. Our financial advisors are specifically trained, as I said, towards your profession. And basically, we are specialists in that field. So it's making sure that you are getting that specialism advice as and when you need it. Okay, Holly.
Just checking that they're coming through, Val.
Fine.
Not sure if we're having an issue with the slides.
Okay.
Yeah, to put on the slideshow mode, which is
It should be already. From current slide.
I mean, I'll keep talking anyway, but
you see that?
Sorry, carry on. So what do we do? Well, pretty much everything. So it all starts from protecting your income. That's the whole reason we go to work, protecting your family, protecting your borrowings, and also looking at things like retirement planning for the future, the most tax efficient way of saving, how you can use up your allowances. If you were looking to take out a mortgage or a second mortgage or a third mortgage, we're mortgage brokers as well. We're also insurance brokers, not just for travel and motor and home, but also professional indemnity cover. So, I've got a lot of clients who are not just doing their GP sessions or their PA sessions in a hospital. They all do private work as well. So, the impact of having a private income is huge when none of that is attracting superannuation. So that's another area to think about. And also estate planning. So, even though we like to speak to our clients when they've started their GP training or their FY1 or FY2, I've got clients that have now retired and still have issues because they've accumulated this wealth. And, what is the best way of making sure that it passes to their family as opposed to Rachel Reeves? So, there's always going to be that financial assistance that you'll need, and we're there every step of the way for you. So I don't know if there's any other screen it will go into. Or...
Should be moving now.
No.
Sorry, I don't know what's happening with the slides.
yeah, moving now. Yeah.
Yeah, it's moving now. Sorry about that. Okay, so basically what we're going to look at today is, what does your retirement look like in today's world? There's been a lot of changes in the last few years, and, it's no surprise that, it's just full of complexities. Where do you stand with your own total reward statement? In fact, when I do talk to my clients and ask them, have you ever seen your total reward statement? Do you know where you can obtain it? A lot of the time they don't. So it's really making sure that we educate our clients as to how they can keep on top of things like their total reward statement early on in their career. We'll look at the options available for you, the impact of early retirement, the pension age discrimination. Obviously some of you may have heard about the McLeod judgment. No, there's been a big impact around that. The tax implications, but also what do you do personally in order for you to make the most of not just now but the future as well. Okay. Nope, I can't see that.
Yeah, I'm not sure what's going on. If I change it to this, is that moving?
It's just stuck on that same slide.
Just go and click the next slide on this left-hand side.
Holly, in our screen, your one is not in the full display. It's still in the kind of...
small display. Yeah.
That's strange. It should be showing the... 1 second. Let me try this.
Yeah, that's good.
Sorry about this.
Sorry.
It's okay. Yeah, and now it's okay. Yeah.
Oh,
Now
it's bigger now.
Yep.
Yeah, it's definitely bigger. Okay, so as we said, what does retirement mean in today's world? Basically, with your retirement, are you going to be looking to supplement your cost of living when you do retire? Is it going to be your finish line, or do you think you may be wanting to carry on working and take a partial retirement? And what is going to drive those retirement plans? So we all know that people are living longer and they're in better health now. So obviously the pension side of things may have, your pension may need to last a lot longer. The increasing demands and pressures in the workplace, you may just decide you want to leave earlier and not do any more, finish at an age when it suits you. The taxation side of things. So, when you look at things like the lifetime allowance, which is now no longer the case, there is certain rules around that still. And will that be one of the things that might impact it? There's a lot of opportunity and uncertainty, but it is one of the challenges that you will need to look at when you're sitting down and talking about retirement. And also when you're looking at, researching your own retirement planning, do you know which options are going to be right for you? Or do you want somebody who's going to be there to hold your hand on a regular basis to make sure that your retirement objectives are being met and on track? So the most important thing is to sit down and set your goals. What is it that you're looking to have for the future? What is the most important thing for you? Is it making sure you've got the flexibility to retire earlier? I mean, some of my clients don't want to be working until 68. That is the official 2015 scheme age at the moment, depending when you were born. And I've got some clients who decide that they want to retire 10 years early. But at the end of the day, what is your goal in order to make sure that you obtain that? And it is all about creating that plan and sitting down and putting things in motion and putting things to plan. Okay, so when it does come to retirement, what do you actually want to do? So when I sit down and look at retirement planning with my clients, it's a case of who will you be spending that time with? What do you want to do in retirement? So, a lot of clients want to play golf, for example. That's a very expensive sport. So, we always factor in those sort of things. You're going to have more time in your hands. Where will that money come from? Where will you spend the time? Again, a lot of us want to go to far-flung countries. We want to make sure that we're able to enjoy traveling. Again, it's going to cost money. So where will that money come from? When is the right time for you to retire? How much will there be in your pension pot? All these things are going to be key factors in order for you to sit down and look at where you go with your financial journey. Okay, so basically, when we look at this example, I mean, this was based on only a year ago, but the average life expectancy now for a male retiring at 60 is 85. So you've got a good 25 years if, for example, you took your 1995 scheme as to, you know, how you're going to fill that time and where will that money come from. But then there's also a chance of 1 in 4 of us reaching the age of 92. And if you're really lucky, a 3.5% chance of living to 100. And it's even more so for the, you know, for the females. But I think the bottom line with this slide is, where is that money going to come from the longer that you're actually going to be living and doing the things that you want to do in retirement? Okay, so basically, you know, depending on when you started with the NHS, you're going to be in one of 3 schemes. Okay, so if you started many years ago, you could well be in the 1995 scheme. Now, with the 1995 scheme, you can take your pension at 60, okay, and you will automatically get a lump sum. If you're in the 2008 scheme, your official retirement age is 65, okay, but there is no automatic lump sum, although you can request it. And now everyone is now in the 2015 scheme as from 2022. And the age that you retire for your 2015 scheme is in sync with your state pension. So if you were born in the 60s, then your 2015 scheme is likely to be 66. If it was in the 70s, it's 67. And if you're born from 1980s onwards, that pension age is going to be 68. But, you know, there are talks of the state pension going up to 71, in which case so will your 2015 scheme. But don't let these figures be the driver for your retirement plans, because if you do plan early enough, you know, you could look to take your pension a good decade early before you start taking your NHS pensions. And it's all about early planning. So again, it's going back to that, you know, it's going back to those factors. What is your definition of retiring early? What does it mean to you? Does it mean that you're going to retire and start doing 4 sessions a week, for example, in your practice? Or does it mean that you'll spend 50% of your time in a hospital? Again, how are you going to fill that time? Where is the money going to come from? And where are you going to get that financial independence if you can't access your NHS pension schemes until 60, 65 or 66 onwards? Okay, so financial independence, what does that mean? Does it mean, you know, once you paid your mortgage or your debts that you become financially independent? Does it mean that you're going to have enough income for yourself to have disposable income to do things that you want to do? Is it the saving and investments that you've been saving into, so you've got those holidays and be able to enjoy your social time? Does independence mean that you've still, you know, you've got essential money to spend as opposed to extra money for discretionary spending? Where will those income streams come from? And again, it's important to make sure, you know, that we all understand what will happen as you approach your retirement years. Okay, so if this slide here is basically giving you the impact that if you decided to retire and you wanted to take your pension 5 years early, you are looking at a reduction of just under 20%, well, 18.8% actually, if you took the 1995 scheme at 55 as opposed to 60. So, you know, that's nearly a fifth of your pension pot gone if you decided to take it early. If you were looking at the 2008 scheme, there's going to be a 21% reduction. And if you decided to take the 2015 scheme by 5 years earlier, then it's even higher, which is just under 23%. So by accessing your NHS pensions, if that's all you have, it's going to be a massive reduction in your final pension pot that you strive to increase over the years that you've been with your superannuation scheme. So this slide is giving you an impact of what, you know, how much less of that pension pot will be if you relied just on your NHS pension. Okay, so one of the things that has been that has really added a layer of complexity is the McLeod judgment. Now, the McLeod judgment is a High Court judgment, or was a High Court judgment, because some of the older members of the NHS pension scheme were able to keep their pension schemes for a lot longer and were in more attractive. They would have achieved more attractive benefits than the younger population. So that was deemed discriminatory against the younger members of the NHS pension scheme. So what's happened now is that in the 7 years that the changes were made, from 2015 to 2022, anybody who had gone into the new scheme has now been put back into their original scheme, or what's called their legacy scheme, which is the 95 or the 2008 pension, because they would have been told to stop in those pensions and move into the 2015 scheme, which wouldn't have been deemed more attractive for them. So in that 7-year period, there's now what's called the legacy scheme, which is where those contributions have gone back into the original scheme. So everybody now from 2022 is in the 2015 scheme, but you don't have to worry about any of that now. It's only when you come to take your retirement, the NHS will offer these pension options for you. Would it be better for you to have taken the scheme if you remained in the legacy scheme in those 7 years, or in what they call the reformed scheme in those 7 years? But one of the things that we have, or we do at Wesleyan, is we can forecast and give you those pension projections in advance to see what your pension could look like based on some of the information that we'll need, like your total reward statement, your income, your future income, what it might be. And we can actually look at projections of where you may want to retire. So that's another area that we can go through if you are looking for further advice, but we do have those options for you. The other thing that's changed, where the government, the Conservative government changed this 2 years ago, is something called the annual allowance. So at the moment, you are able to put up to £60,000 into a combination of pensions. So whether that's your NHS pension, depending on what your salary is, or private pension, but it shouldn't be more than 60,000. 2 years ago, it was 40,000. But because there was a mass exodus of medics leaving the profession, the government had to make it attractive for those medics to stay. So now you can put up to £60,000 into a pension as long as you're earning that much in the first place. And then basically, if your income is more than 200,000 or 260, depending if it's what's called threshold or adjusted income, and the difference between that is whether you've got pension contributions included in that income, then, you know, it's even less. You're able to pay even less into a pension if you're lucky enough to be earning £260,000 or more. But anyone under that, you can put up to £60,000 into a pension, and that is called annual allowance. But these figures here are very technical, and it's only on a one-to-one basis that, you know, we're able to go through that in more detail. But at the moment, you just need to remember that if you're earning less than 260,000, then 60,000 is the amount of income or pension pot you can actually put into each year, and you can carry forward 3 years as well of unused pensions to make it more tax efficient. Okay, so basically the other thing that used to be around until a few years ago was the lifetime allowance, and this is where a lot of medics left. The older medics left because their pension pots had swelled to more than £1 million, because after that they would have been taxed at the higher rate. Well, the Conservative government done away with all of that as well. So basically there is now no £1 million or 1,073,000 at the last count for you to actually add up on your pension pot. But if anybody was retiring and they were looking to take their 25% lump sum, because that's the maximum you can take out from your pension, then that figure is still there. You cannot take more than 268,275 in lifetime allowance money, tax-free income, unless you have what's called individual protection. So that's another layer of protection that years ago some of the elder medics might have protected to make sure they got a higher tax-free cash lump sum. All right, so you can see it starts getting a little bit more technical, but the basics is there is no £1 million pension pot allowance anymore, but there is a lump sum maximum you can take out from your pension pots, which is just under 269,000. Okay, so is personal pensions the only, is the NHS pension the only thing that you can do in order for you to then look forward to your retirement? Well, the answer is no, because there are other things that you could be utilising in order for you to start building up your pension pot. So you could look at personal pensions. I do a lot of personal pensions with my clients who have also got sole trader or limited companies, which is very tax efficient, but it's also making sure they're utilising their private income. You can look at utilising your ISA allowance. Everyone is allowed £20,000 worth of ISA income going into either an investment or a cash ISA. You can look at unit trusts. Of course, you are still taking risk on the stock market, but if you were looking to put money under the mattress, you're still taking a risk with your money, because when you look at inflation, you've only got to look at the cost of things when you go into Tesco's, for example, and see just how high these, your food shopping bill is. So inflation very much does eat away into savings that are just, say, sitting in a bank account. But when we advise clients, we always say you should have emergency funds. At least 3 times your net income, monthly income, should be emergency funds. But then what are you doing with the rest of the money, which you could be using in the most tax efficient way possible? And again, those are the other areas that you could look to utilise as part of your pension planning. Okay, so we've touched on this a little bit earlier. If you've got, if you're somebody who actually is not just doing NHS work, you're doing private work, one of the beauties of actually having a personal pension is that you can class it as a business expense. You can offset it against your tax return, and it's a win-win, because not only if it was a sole trader, not only is the government putting money into your pension, but you're saving on tax as well. So it's one of the most tax efficient saving ways of saving for your retirement. And at the moment, you can take personal pensions from 55. That is going up to 57 in 2 years' time. But when you look at when you can take your NHS pension, it is still 10 years earlier, a decade earlier than if you had done nothing. So it gives you that flexibility of actually retiring or taking partial retirement if you had pension planning done in the first place. Okay, again, the actual advantages of putting money into a pension scheme. If you've got a limited company, it reduces your corporation tax, your national insurance, it increases your own retirement pot. And basically, if you've got any debts to pay, it protects it from creditors of the business because it's going into your retirement. The other thing that we do with our pension projection is that we calculate how much annual allowance you've got. I've got clients who've carried forward 3 years of their pensions that they haven't used and put in lump sums, because that will just grow for their retirement. So the most important thing I would say is that please keep on top of your total reward statements. It's really shocking how many of my clients haven't even accessed a total reward statement or don't understand how their pension pot is growing on an annual basis. Okay, Holly. Okay, so again, it's back to those key words, setting your objectives, making sure that you review your funds on a regular basis. And if there needs to be changes to be made, that's what we're here for. So at Wesleyan, very much so, I do touch base with my clients on an annual basis, at least, to make sure that we are on track to get the retirement that my clients want. Okay, the other thing that has really mushroomed with Wesleyan is that we do have a retirement club. Now, this retirement club is free. It gives you a lot of informative information that Wesleyan gathers and sends out to its members based around the medical profession. And it is all about their dream retirement. So anybody can subscribe onto the retirement club. And if you did want to, you know, have a chat with me afterwards or arrange to have a one-to-one session, then I can introduce you to the retirement club. But it's a very good way of seeing where your retirement planning is going. You'll get that advice from a specialist advisor who understands your NHS profession. We'll give you invitations to exclusive live events and webinars to make sure that you're kept up to date. And also, there's a dedicated retirement hub that's full of information for our medic population and calculators as well to support your financial planning. Okay, so my role now is to basically make sure that we're able to sit down, have a conversation with you, see what you'd like to do, how I might be able to help you, not just now, but in the future. Because everything today that I've actually explained is all generic. Everyone's circumstances is going to be different. They're going to be different ages. They're going to have different retirement pots. They're going to have different salaries. And they may be doing other roles as well as NHS work as well. So it's a case of sitting down and having that initial half an hour chat to see how we may be able to help you. Because as I said from the beginning, we only deal with medics. Our training and knowledge is based around your profession. Okay.
Yeah, before I move on to the questions, just that's to scan the QR code. If you get your camera up on your mobile, scan it through and it should take you forward to a link. You just pop a few personal details there and it'll come straight through to myself and Bal, and Bal will pretty much drop you an email first thing tomorrow to send you some dates and we can get your Microsoft Teams link sent over. But if the QR code doesn't work, please let us know and we can obviously just drop you an email personally as well through anyone who's organised it. And yeah, we will pop over to the questions then and see if anything has come through.
So, thank you.
That's okay.
Yeah, there's one of our member asked this question. She's Padma Sukumar. What is the best way to minimize the tax payouts after retirement if you continue to work reduced hours?
Right. Okay. What's the best way of reduce your tax? You say?
Minimize the tax payouts after retirement if you continue to work reduced hours.
Yeah. I mean, the first thing that we should look at is basically when you're timing is everything when you're looking to take your retirement. So the first thing we need to be looking at is what tax level band will you be when you're looking to retire? What will your salary be when you look to access your benefits? And don't forget, with the NHS pension, you don't have to take all of your pension in one go. You can do what's called a partial retirement. So you can take up to 20 to 100% of your retirement. You don't have to take it all. And also you've got retire and return options as well. But if you're looking to reduce your hours, the tax implications could be, well, you know, how much over are you going to be from your tax threshold? And that's where we can do those calculations way in advance to see if it's to your benefit to retire earlier, or is it best for you to go on for another year, or perhaps leave a little bit earlier as well. So those are the things that we can do for you, but it's all going to be based on what income you're on, what tax band you're on, and we can get those technical calculations to give you that information in far more detail.
Excellent. Excellent. There's a new question comes on from Sudhakaran Velayudam. What is the minimum value in pension to claim lump sum at retirement?
Okay, well, if you are in an NHS pension scheme or any pension scheme, you cannot take more than 25%. There is no minimum lump sum. If you're in a pension scheme, you can only take 25% maximum, as a tax-free lump sum. The rest of it will be based on your marginal rate of tax. So whatever that pension pot is, 25% is the maximum of that pension pot that you can take as a lump sum, whether it's £3,000 or whether it's £300,000.
Perfect. I think Sudhakaran got the question. Then the next question here, Ponuthurai Pradeepan is asking this question. How does it affect your pension if you take salary sacrifice fleet vehicle?
Fleet. Sorry, I didn't understand the last.
His question is when you take a salary sacrification fleet, you know, the vehicles, when you
Yes.
when you take it, how does the pension allow? How does it affect your pension if you take one of those vehicles?
Yeah, I mean, I don't get involved. That's the side that the NHS Pension Agency would deal with, because the fleet side of things is a benefit that the NHS employer gives you. So we don't tend to get involved with the fleet side of things. But if you're giving that up instead of, and you're getting a fleet vehicle, then, you know, it's going to impact the figures in the future anyway. But the only way, again, that we can look at that is have a look at where your total reward statement is at the moment, and then compare that to once you have your fleet benefit, in order to then see what those differences are. But if I'm honest with you, that is an NHS Pension Agency question that they'd be able to answer in a far more detail than me, if I'm honest, because that comes under an NHS benefit as opposed to financial planning.
Thank you. Deva Loganathan is asking this question. You mentioned a figure 60,000 in your presentation. So
Yeah.
does the pension allowance 60,000 include employer contribution as well?
It's all, everything, employer, employee, personal, all of that together. If it comes to more than 60,000 in that pot, yes, it would include the employers as well. It's all of it.
Thank you. Thank you.
Mohan,
Yeah.
Ashok Nathan's hand is up for some time, so you might want to ask him. He wants to ask something directly. Ashok.
Okay, please.
Thank you, Nishant, and thank you for these useful tips about the pensions. It's very, very, very useful.
Yes.
Thank you for
You're
presenting.
welcome.
Yeah, just my quick questions. You mentioned about that annual personal allowance 60,000 and the total reward statements we need to keep an eye.
Yeah.
Total reward statements. My question is that the amount is equal to adjusted income. That is the one we need to worry about when it goes to more than 260.
If you're earning more than 260, the adjusted income takes into account things like your pension contributions in the first place. But if you're earning over that figure, then you won't be able to put 60,000 in, because for every £2 that you're over, it reduces by £1. So those figures are completely different that you can put into a pension if you are earning more than 260,000.
Okay, so the total reward statement is equal to adjusted income. Am I right? That is
sorry, say that again.
the total reward statement we get on the ESR normally.
Yes.
That is equal to adjusted income. That is include the pension contribution from the employer service. Yeah.
Your pension contributions, because you would also get what's called an annual allowance letter, and that will tell you what your opening and your closing contributions will be on a yearly basis. So I don't know if you've seen that, but that will also show you how much has gone into that pot from the employer and the employee on an annual basis.
Okay. So when it goes beyond 260, we need to worry, isn't it? So we need to
your income. If your income is above 260, that's where the amount that you can put into your pension will reduce. Yes.
Yeah. Thank you.
Have you got any Can I send my CV to you then?
Yeah. I will be in touch. I will be in touch anyway.
Thank you.
Thank you. Next question from Taya Ahilan. Which is the best, 24 hours retirement or flexible retirement for a GP partner?
Okay, I think it's all going to be dependent on the figures. It's all going to be dependent on your personal situation. It's going to be dependent on whether you can survive on the partial retirement, because with partial retirement, you can, if you took all of the retirement, you need to be off for 24 hours and then you can come back and join the 2015 scheme, and you can start building your pension pot again, which you weren't able to do in the past. With partial retirement, you don't need to take all of that money, but it will also then, you also then have to negotiate your contract with your employer. And I think you also have to give up 10% of your pensionable earnings in the first year. So they're very different rules. We're taking the full retirement and coming back, or partial retirement. And it's all going to be based on your you know, your specific figures and what it looks like for you come in those few years' time. But partial retirement has got its own rules. It's not just a case of taking between 20 and 100% and then coming back, because you have to negotiate your contract with your employer.
Thank you.
Sorry, partial retirement, can we take lump sum money or not? 25% of lump sum money?
You can, yeah, you can take, if you're in the 95 scheme, you're automatically going to get the lump sum anyway. But yes, you can take your lump sum money. That's not an issue. And then you can still take partial retirement. That's not an issue. But those figures have then got to be calculated by the NHS Pension Agency. But the rules are different for partial retirement because you have to give up some of your income or reduce your income in order to then carry on working. I think it's like 10% of your pensionable pay. Whereas
so for the 24 retirement, so we need to
take the whole lot.
Yeah, finish the contract and rejoin it, or
yeah, and then rejoin it on a new contract, because then you will be open. You can then carry on in the 2015 scheme, because you can't take the 2015 scheme until you get to the age of 66, 7 or 8, depending on your age. But you can carry on contributing.
So it's completely different both. So
it's two different. You will have two different pensions. You'll have, if you were in the 95 scheme, you can take that pension at 60, but in the 2015 scheme, you're more likely to take it at 66. So it's a case of what happens in those 6 years in between. So, you know, you may decide that you may have wanted to do pension planning to bridge that gap, but you can take partial retirement, but they do come with rules, and you've got to renegotiate your contract with work as well.
Thank you. Yeah.
Does that make sense?
Yeah. So, thank you.
Thank you.
No worries. No problem.
Dr. Rajaratnam is asking, please tell something about, sorry. The questions are running about different...
You would have already answered, but I just wanted to see what kind of options we have. There are 3 options, I gather. I'm not sure. Maybe I may have to talk to you guys personally. I have already sent the links. But if you can some sort of give a guidelines or some idea, what are these 3 or 4 types of retirement and return?
Right. Okay. Well, there's the retire and return is where you can actually take your full pension. You then have to take a 24-hour break. And then you come back on a new contract, and basically you would then be able to still carry on contributing into your 2015 pension scheme. You weren't able to do that 2 years ago. That has only just recently changed.
Are there any option without changing my contract or anything like that? Kind of, there's one option somebody was talking, I was not clear about it. Are there anything like that?
You can do that, but it will depend on what if your employer agrees with what you want to do. It is very much a local decision as well, so you will need to put that to your employer.
Okay.
Well, but you can do that, and you can carry on with your 2015 scheme to further boost your pension planning if you're not ready to retire yet.
So that's the one you are talking about, the partial retirement, no? The same.
The partial retirement is the one where you can take between 20 and 100% of your pension, however you want to take it. But when you come back, you can still carry on in the 2015 scheme, but you will have to give up some of your pensionable pay in order to come back on a partial retirement, which is a little bit different to the full retirement.
We can continue the same contract with the employer.
Yeah, but you would need to negotiate that with them, because that's something outside my remit. It's if they agree with it, basically, because they're the ones who are going to be having you in their practice. But it depends on, but you would definitely have to take a 10% pensionable pay reduction for the first year in order to do it on a partial retirement basis.
Okay. Thank you.
Thank you.
Problem.
Thank you. I think this is Dr. Yoganayam asking this question. 1995 scheme breaks. Maximum, is it 5 years? Is that correct?
Yeah, 5 years.
If multiple breaks exceeds 5 years, are they eligible for final year link?
I think if it's beyond 5 years, they've got separate rules for that. As far as I'm aware, the link is only if it's less 5 years and below that you've had that break. I think the rules change after that.
Thank you. Kamala Pahirathan is asking this. Will he be losing if we take 1995 pension after 60 years of age?
No, the pension is, I mean, I've got clients who still haven't taken their 1995 pension and they're 65 because they're still carrying on working. If they took their NHS pension, it would then mean that they're going to be taxed because they don't want to reduce their hours at work. So you don't, as long as you take your pension before the age of 75, you don't have to take it. It is still growing in the background, not as much. I mean, it is still growing in the background, but not as much as if you were actively contributing, because you are now in the 2015 scheme. That is where everybody is now contributing. But you don't have to take your retirement at 60 for the 95 scheme, no.
Is it not disadvantage not to take at the 95 scheme because we are losing lump sum money? Because my friends are not taking, so I was not sure. Yeah.
Well, I'll have it if they don't want to. If you give it to me. But
my understanding is we will lose the lump sum money.
No, you won't lose the lump sum money. That's your money. You've just ring fenced, and you can take that when you need to. You won't lose that money. That's your money. When you decide to take it is entirely up to you. But as I say, you should be taking it when you're at your lowest marginal rate of tax, so that you don't get a large tax bill by taking your NHS pension. So the most useful thing would be to reduce your sessions at work so that you can then have your NHS pension in sync, so you're not paying a higher amount of tax. Okay. So this is where the timing is everything when it comes to pensions.
Thank you.
But as I say, everybody's total reward statement is different. If there's one thing that I would really scream, especially with GPs clients, is that there are so many gaps with their pensions because they have either not put their Form Bs in, or it's too late. Then the PCSE has to get involved. It becomes a nightmare. So if it's one of the things that I would say is please keep on top of your total reward statement. They won't be sending them in the post. It is like online banking now. You need to register and log on to access your ESR portal or whatever outlet you use for your total reward statement.
Thank you.
All right.
Sudharan Belaidam is asking another question here. How this pension scheme work for someone who spent only 3 to 5 years in NHS? It's an extension. He's asking how the current system support to change this pension to our home country pension scheme.
To your home country pension scheme? Okay, so somebody who takes a break from their pension or is no longer actively in the pension is called a deferred member of that scheme. So they can always come back and get back into the scheme, because I've got clients who have moved to other countries but obviously can't put any more into the pension scheme because they're not NHS workers. But that pension will always be there. So, even if you went back to Sri Lanka or Canada or wherever, that pension will still be paid to you into a UK bank account. So you are currently what's called a deferred member unless you activate that pension again. But it will always be there until you're ready to take that the benefits.
Perfect. So in addition to this, if I ask you this, so for deferred members, how do they access their ESR?
For any members, you mean?
Any members.
Well, I think one of the other things, because you know what it is, the NHS pension have started using so many different ways of actually accessing your pension. Before it was the ESR portal. There's also the government gateway portal. So, I think the best way would be to actually either go in-house and look at the practice and see what portal they use, or ring up the NHS pension agency, and I can give you that number. That's implanted in my brain, but that's the first thing I would do, because they will send you out and email you your most recent statement. But after that, you really need to start logging on. But the NHS pension agency will always help you. They are really good. If you give them a ring as well, they'll point you in the right direction, because there's so many different portals that you can use to register now and access your portal. It gets confusing.
Thank you.
As far as I'm aware, the ESR one is the main one that used to be the main outlet for getting total reward statements. If you can,
you could pop that number in the chat box, Bal, if you want. So that they've got it.
Just trying to where's the chat box? Okay, So if I just put that in there now, so that you can. So I'll just tell the NHS pension agency tomorrow. Just expect a whole load of people ringing up for their NHS pensions. Can everyone see that number?
Yeah.
Yeah, that is the NHS Pension Agency number.
Perfect. Thank you.
All right, no worries.
Thank you. I think we are coming to the end in the questions in the chat box. We have a few more minutes. Can I ask you a question? So, is it worth for a member who joined NHS in his later age?
Yeah.
Is it worth buying additional pension years, or
Okay.
is it possible or worth?
Yeah, I mean, with the 95 scheme, you were able to buy added years and had a lot more flexibility. With the 2015 scheme, you can still buy an additional pension, but you can only have a certain amount. I think it's like £250 a month. It's no more than £3,000 a year that you can boost your pension pot with. And that's where the personal pension side of things come in, because you are very much restricted on how much you can put into the NHS pension, because it's based on your salary for a start. You do get that additional pension that you can, because in the old schemes, you could always have added years, but you don't get that with the more recent pensions. So it's then looking at what other options have you got. And it's as we discussed earlier, you've got the ISAs, you've got the personal pensions, you've got the bank savings to boost those coffers. But the NHS pension scheme is one of the best pension schemes going. So you might see a big pay slip debit coming out of your, out of your pay slip. I remember when my daughter first got her pay slip, because she's a medic, and she said, I'm not going into that NHS pension scheme. So when I explained that not only do you get a spouse's pension, you get a dependent's pension, you get death in service, you get an ill health retirement, it is one of the best pension schemes that you can have. And it's a pension you will get for life when you retire. So, we wouldn't recommend anyone coming out of the pensions NHS scheme unless there was a really good reason to do that. But yeah, it's never too late to boost your pension pot, but there's only a certain amount you can put into the NHS pension, and it is like £250 a month extra.
Thank you.
All right.
Look like there is no more questions. Anybody want to ask any questions? Thank you. That was a great presentation.
Oh, no problem.
That was a very great presentation. Thank you, Val and Holly.
No problem. It has been very generic just to make sure we've tailored it to everybody, really. But as I say, everybody's situation is different. And if they do want to catch up, if they do want a half-hour video call, then let us know, and then we can always touch base and book that time in for you.
Thank you.
Yeah, it's also worthwhile mentioning. Me and Val do these, not only over webinar, but we come into your local practices as well. We can get staff together, GPs, whoever's available on the day. We do an hour on a lunch. We can bring lunch in and help as many of you and your colleagues as possible as well. So do just let us know if that's something we can help with too.
Thank
Definitely.
you.
Would you able to give you a number to discuss personal reward statement, TRS?
Yes, I think the details. If you register on the is that right, Holly? If you register on this thing,
yeah,
I will then get in touch with you and we can arrange something. That's not a problem.
Yeah, that'll come straight through to us, and Val will pop you an email over straight away. Yeah.
So how to contact through the email? Or?
Yeah, if you just get your camera up and scan this code here.
Okay. Yeah. Right. Okay.
On the
Yeah,
screen, it should have a link that comes up.
Yeah.
And then there should be a form, and when you submit that'll come straight through to us.
Okay. Thank you.
Yes, as we expected, 75% attended.
Amazing.
Thank you.
Brilliant.
Thank you.
Well, I hope it was useful. And I look forward to seeing everyone.
Thank you. Thank you very much for Val and Holly.
Val and Holly, I have already done the links, and you will get that. And
Thank
I
you.
will possibly next week or week after. I need to talk to one of you.
Yeah, I got the acknowledgement already from Wesley.
You've got what? Sorry,
well.
You have.
I got the acknowledgement from your site already.
Oh, I see. Oh, amazing. So you're two officials. Too efficient. But you know, we will catch up. So yeah, but thank you so much. It's been a real privilege to actually attend the session as well. Yeah, really enjoyed it. So thank you to the audits and yourselves. Thank you.
Thanks, Holly. Thanks, Val.
Yeah,
Thank you very much.
Thank you, and we'll see you
Thank
soon.
you. Thank you.
We are going to stay for a while, our committee members. Thank you, both of you.
No problem. Take
Thank
care.
you.
Bye.
Bye.
Bye-bye.
Bye.
Sivasudan.